Then welcome back to my YouTube channel. In this video, I want to burst some of the myths which are related to quant finance. See, I'm in this field for more than 5 plus years, and I still remember, when I was starting in this field, there were a lot of people who used to speak a lot of stuff, and now, in last 5 6 years, I've realized all of them are not true at all. So let me walk you through the 7 myths that I've heard the most, and then one by one I'll just walk you through about what my experience is. So the first myth is, okay, quant finance is only for math geniuses, and specifically if you see in India, a lot of quant companies, they hire only from IITs, right? So that is myth number one. And just I'll just walk you through all the myths, and then I'll share my experience. So the second myth is cons only focus on trading or generating alpha. This is the second myth. Third myth is quants only work on Wall Street. Fourth myth is quants are only, good programmers and they only program in C++. Fifth myth is quants make more than $200,000. Every quant is making $200,000. Whosoever is sitting in USA, Sixth myth is all quants have PhD level degrees. And seventh myth is machine learning will replace all the quants, whosoever it is. So these are the 7 myths that I will be covering in today's video. So the first myth: quant is only for math geniuses. Not at all true. Okay, remember, quant is made up of 5 disciplines, mathematics, statistics, finance, economics, and programming. So if someone is very good with math, math and stat, but what about the rest? Is he able to understand the finance part of it? Is he able to code properly? So if someone is saying, okay, only math geniuses or people who have cracked Olympiads, math Olympiad, for only those, quant finances made up, only those people can enter into quant finance, it is absolutely rubbish, absolute rubbish on that. I've seen a lot of BCom, my batchmates, back in North Carolina State University, where I did my masters in financial mathematics. There were certain people who were, MBA graduates. There's a certain people who did BCom, and they were able to transition to quant finance. And BCom people, this guy from BCom, he never studied anything on calculus. But again, this guy worked pretty hard. He learned calculus, linear algebra, during the master's degree itself. So it is not that only people who are from engineering background can transition into quant finance. No, if you're a BCom graduate, chartered accountants, MBA, engineers, engineers, you guys are very well suited for quant finance, because you study linear algebra, calculus, a lot of subjects which are actually taught in, or let's say which are used in quant finance. So definitely you guys are great. But if someone says only math geniuses can enter into this field, it's absolutely rubbish. So don't listen to these people. Second myth: quants only focus on trading. See, in India, you will see most of the quant related positions are only focused on trading, but that is not true. I mean, see, trading is just one aspect of it. You will see people working for portfolio management. Then, of course, trading in one aspect. Then the third aspect is risk management. Fourth aspect is derivative pricing. So, it's not just only people are only working in trading, but they are working in variety of fields. Portfolio management, risk management, and then again in risk management you have market risk, credit risk, liquidity risk. And I've seen quants building, all this mathematical models for different kind of risk they are working in. So it's not like, okay, if you are a quant, then you can only work on the trading side. No, I mean, some people don't like trading at all. I mean, so it's not like, okay, so you cannot be a quant anymore. No. I know so many cons who are working, who are working in hedge funds in the portfolio side, and similarly, a lot of people are working in the algo trading side. So making sure you understand this. If you're not someone who likes trading, like I don't like trading, I like to build mathematical models. That is my strength. So don't worry. It's not that if you don't like trading, you cannot enter into quant finance. Trading is just one field in which quants, work in. So there are not, there are rest of the fields which you can also target. And one more field which I sorry missed out is model validation. You will see a lot of cons working for model validation and derivative pricing and fixed income pricing also. So don't worry, if you're not interested in trading, I would highly suggest focus on other areas. Third myth: cons only focus on Wall Street. Oh, sorry, cons only work on Wall Street. Absolutely wrong. Absolutely wrong. See, okay, I'll share my journey. I started with Regions Bank back in after graduating from my master's. So this is a commercial, really big commercial bank in south part of US, and but this is not even closer to New York. It's really far to New York. And right now I'm in Denver, Colorado. So, but that doesn't mean okay, I'm not a con. Yeah, definitely. One thing is true that cons they definitely a lot of cons work in the Wall Street, but then there are a lot of commercial banks, brokerage houses, insurance companies, where hedge funds, where cons work, and these are all based out of different states in the US. So it's not like if you're not working in New York City or if you're not working close to Wall Street, you're not a con. Please do not fall into that trap. Always remember, cons can work for different types of financial institution, right? Banking is one area where you'll see most of the cons working for, and then you will have brokerage firm, insurance company, there are a lot of asset management companies, that hire cons, hedge funds, prop trading shops. So don't worry if in case you're not working in New York, but it's a personal decision to where you want to work. So don't worry, but definitely it is not the case that if you're not working in New York, or if you're not working in the Wall Street, you're not a quant. So don't worry on that myth. Fourth myth is quants are great programmer. They know everything. They are great with C++. They are amazing with their toolkit. See, let me help you with this. There are different positions in quant, right? Quant analyst, quant researcher, quant trader, quant developer, model validation. Then you have few quants working in the risk side, market risks quant, credit risk quant. So when someone says, oh, you should have great programming, quant should have great programming, definitely I agree to that point. But people expecting you to be a top-notch programmer, you should know data science and algorithm, sorry, data structures and algorithm, which is DSA, right? That is very specific to quant developers. So if you are a quant developer, definitely you should know data structures and algorithm, because that will help you optimize your code. But let's say for quant researchers, for quant analysts, if you're good with Python, that is more than enough, because most of the institutions, they are using Python. So some people say, no, Mehul, we have learned that we know that people also, firms also expect you to know C++. But then guys, understand, C++ firms, only trading firms, high frequency trading firms, only these kind of firms will expect you to know C++ or algo trading firm. And why is that the case? Because C++ in general, the execution time is much more faster than Python. So definitely in there, when they are, when every millisecond matters, definitely the execution speed also matters. So that's why for them, is definitely one of the checklists that you should come with. But if I'm talking about banks, brokerage houses, financial, insurance companies, portfolio side companies, when you are need to do put something on the portfolio management side, understanding the risk and return, there what they're expecting you to know is Python. So what I would suggest is, if you don't know C++, that is totally fine, because that is very much required for a quant developer position. But if you are aiming for quant analyst, risk analyst, credit risk analyst, market risk analyst, quant researcher, then Python is the go-to language. And for quant traders, neither of the programming language is required. For quant traders, what firms are looking for is, you should be good with mental math. You should be good with your mathematics part of it. If they ask you to do calculation, you should be good with that. If they ask you to find out probability of some events, you should be good with that. They are looking more from a mental mathematics perspective. You should be good with math basically. But for quant trader, programming is not at all required. But again, here is the thing: if you're looking for algo trading, in algo trading, the whole setup is completely automated. There is no manual intervention, and that's where they would expect you to know Python and C++. But when I refer to quant trading, in which the trader is calling brokerage houses and executing the deal, that's where you don't need any Python languages. You should be good with understanding the financial intricacies of the market. You should be good with analyzing the number. You should be good with understanding the events, the scenarios. That is what you should be good with. You should be good with understanding what instrument it is. Let's say if it's a derivatives, you should understand what is forwards, when to use it, what can be the risk. So that is what is expected from the trader. So but again, people saying, okay, you should be great programmers, understand, definitely a decent level of programming you should understand. But if they are asking you data structures and algorithm, that role is more towards quant developer. Fifth myth is cons make $200,000. Okay, now here is the thing. So when I graduated from NC State University with my master's in financial math. So okay, financial math, quant finance are all the same. So don't think it's a different degree. These are all the same degree. So when I graduated, I had close to 45 batchmates. None of them got $200,000. Only one or two might have got, but none of them got more than that. So it is not that every quant is making $200,000. Instead, the average of the whole batch was somewhere close to 100 to $110,000, $120,000, somewhere around that. So if you are thinking, okay, you are making $90,000 or $130,000 or something like that, you are don't think you are not a quant. No, if you are working for banks in United States, that is what the starting salary is, $100,000 or $110,000 when you're coming with no experience. Sometimes they will also offer you $80,000 depending on how the market is. But very few institution, they'll offer you $200,000 package, and that is only when you are working for a hedge fund and you are working in a very high performing role. So not every quant is making $200,000. Please understand this. Sixth myth is all quants are PhD. No, that is not true. I totally agree with the fact that PhD definitely helps you in the understanding of the overall field of quant finance. But if let's say you are coming with a master's degree in US, I'm specifically talking about US, right? Master's degree is good. I mean, I've all my batchmates, I guess all my batchmates got placed into some of the other quant finance role. So it is not that if you do not have PhD, you won't get placement or anything like that. Definitely, if you have a PhD, that is definitely plus. That is definitely a good thing. It's a one of the best thing that you can have in your portfolio. But if in case you just have a master's degree, then also you have equal probability of getting selected in any interview. See, from a company's perspective, what they are looking at is you should understand different concepts of quant finance really well. You should have a good grasp of statistics. You should understand different derivatives. You should understand fixed income. You should understand Monte Carlo simulation, have good knowledge of portfolio management. So this is what the company is looking for. So even with the master's degree, you are able to able to tell all of these. I mean, you are good to go. So don't think that if you do not have PhD, you would not get a job. No, that is totally incorrect. Just give me a second. Okay, so the last myth is machine learning will replace all quants. I feel that is absolutely rubbish, and I'll tell you why. See, definitely, if you see all the high frequency trading firm, they are all these people are definitely using machine learning, neural networks. A lot of them are using all these things. Natural language processing, big data analytics. All of them are using. But if you come to the banking side. In banking side, transparency is something that regulators are looking for. So if even ask decision tree or random forest, which is a machine learning model, you cannot just use those models in building any of the modeling piece. So because the reason is because all the banks, they can take a limited risk, whereas all the hedge funds, they are not regulated, so they can take unlimited risk. But banks in general, because they have all the money of the borrowers, so that's why they can take a certain level of risk. So they cannot use as much as machine learning algorithms in their regulatory purposes. So that's why I always say it's not like learning will replace quants. No. I'll give you one example. If you want to do stochastic volatility modeling, right, or if you want to predict the volatility or predict the interest rates, in quant finance, you are definitely taught a lot of different models. Like for stochastic interest rate modeling, they'll start with basic check interest rate model. Then they'll help you with they'll teach you CIR model, Hull White model, and then advanced models will follow, G2 plus plus model, BGM three factor model. All such models will follow, and same goes for stochastic volatility modeling. There is Saber model, 3 by 2 model, CEV model. So in cons, there are separate models which have been built for certain purposes. So it's not like okay, you can just use machine learning models, right? So understand, it is never the case that machine learning will replace all the cons. Itself is a very big field. You should understand you should have knowledge of fixed income, derivatives, Monte Carlo simulation, stochastic calculus, risk management, both credit risk management, market risk management, and also liquidity risk management. So it's a very big field. It is not something which can be replaced by machine learning just by like that. So these are certain myths which I feel, I was also told in the beginning of this journey, and but that is not absolutely true. Also, if you have any other questions, please do post on the YouTube comment section box. Thank you so much.